Chapter 14 is about the definition of managerial accounting. Managerial accounting provides the data from the accounting transactions or the bean counters within a company, sorry to use that word, and providing information on the management efficiency to the organization manager. It's mainly an internal function. Most of this data does not go out to the general public. It's internal. It tells the people who are running the company what's up. It's used, and we talked about this before, planning, control, strategy, evaluation. A lot of managerial accounting is used to review the performance of employees, of divisions, of offices, of units. How did they perform vis-a-vis a plan or a budget? In a couple of weeks, we'll talk about budgets. But it's a use of evaluating, again, the efficiency of the organization. And costs are split into a variety of different areas, as you probably well know by now. Depends also if you're a manufacturing company, if you're a service company. That plays a big factor in how you classify costs. Direct costs are costs that can be directly associated with the production of your product or the providing of the service to your customers. Indirect costs are not exactly related to that cost, but they're on the side. If you look at this graph or this slide, notice if I'm producing a bicycle, all the direct costs there are directly associated with the production of the bicycle. But the indirect costs are related to the production of the bicycle, but not actually related to the process, and it's called indirect. Many times we call these indirect costs overhead. And if any of you work in companies or work on your own business, overhead is something you want to keep track of because it's a killer. And that's one of the reasons why we classify these costs. Direct materials. Materials associated with production. Rubber, steel, whatever. Materials. Usually in most companies, you have a purchasing agent. The purchasing agent goes out and purchases these materials from vendors based on the production needs of the company. They come into a warehouse and then they're allocated to production. Accountants keep track of all that. We don't have to worry about that here. We just have to understand what a direct material cost is. It's actually in our product. Direct labor, the actual individuals who put together the product. If I'm a supervisor, that's an indirect cost. But if I'm actually on the assembly line, if I'm actually providing the service to my customers, that's direct labor. And then, as we mentioned, overhead. Those additional costs, most of them are indirect that you still have, but they're not directly associated with your specific product. But as a lot of us know, a company that is inefficient has high overhead and is doing nothing to fix it. That's a company that needs to fix that because overhead eats up a lot of costs. And it's important to understand what our overhead is. Another designation of costs associated with manufacturing or providing services, is it a prime cost or is it a conversion cost? I can't tell you how many times I've been in meetings over my career and I'm in a meeting and somebody goes, well, our prime costs are under control. We have a labor union contract. We have 2, 3, 4-year vendor contracts with our material suppliers. Those prime costs are under control. It's our friggin' conversion costs, that indirect labor or that factory overhead that we have no control of, that changes from month to month, that's driving us nuts. And many companies have whole departments just to manage those costs and keep track of them. Very important. As I said earlier, manufacturing costs are labor, materials, and overhead to produce a product. Then you have what is called period costs. These are non-production costs. Remember, factory overhead is indirect costs, but period costs are costs that are linked to a time period, 12 months. Manufacturing costs could go over across different time periods because you might be in assembly in December through February. Those costs go across fiscal years, but period costs are 1 year. Selling expenses are typical period costs. G&A expenses are typical period costs. If you're not actively involved in a production process of a company, you're a period cost. If you're an accountant, if you're in HR, if you're in IT, if you're in sales or marketing or advertising, you're a period cost. Companies that are efficiently managed keep track and know, all right, what does it cost us to produce our product and what are our other costs in this company? We need to know what's the difference. That's important. And again, we get all this data from the transactions that the accountants put together. Here's our typical examples of period costs. Notice earlier we saw the product cost for the bicycle being split between direct and indirect. Now this is the same company, but here are the additional expenses that the company has in relationship to their overall product of producing a bicycle. Selling expenses, G&A. And as I said earlier, notice office accounting, office staff, rent, office equipment depreciation, office insurance, office managers' salaries, whatever. To know the difference between period and product costs makes a company more efficient. As you all know, or maybe you don't, but you will someday, one of the first areas when a company's in trouble, what do they do first? Well, they want to, hopefully, they want to keep the quality of their product good so people will buy it. So they're not going to touch product costs. They're going to attack the G&A and the selling expenses. Who usually gets laid off if where sales are dragging? Sellers, marketers. Who usually gets laid off when we're having sales period troubles? Office staff, G&A expenses. Then the next level will probably be related to product, but those are the first people that companies look out for cutting expenses. And as this is what I meant earlier about how costs go across different fiscal years. Period costs are expenses and their rate in that current year. But notice what expenses go from year 2021 to 2022. Those products in inventory that have yet to be sold. Remember, an expense doesn't occur until you actually sell the product. So on December 31st, you're going to have on your balance sheet costs that have accumulated in inventory. Material inventory, work in process inventory, finished goods inventory. They don't hit the income statement until 2022 when they are sold. Then they become an expense. So product costs can be in 1 year as an expense if that product was sold in that time period, but they also can be an asset on the balance sheet as inventory until they're sold later on. That's what makes the understanding the difference between period and product costs so important, because some product costs are sitting in inventory at the end of a fiscal year. You know, Mr. Hassey, I took accounting about 10 years ago, and this was part of the course. I never knew what the frig was going on. Now I do. Well, part of that is because you have also probably have some more business experience under your belt, and you've seen these things develop. This is what managerial accountants do. They take all the accounting data and they separate it into these different classifications. So on the balance sheet, as I said, you have three different types of inventory. All right, at the end of the fiscal year, we have some materials that our purchasing agents ordered that's still sitting in inventory and they haven't gone to the assembly plant. We have some products that are being worked on right now in the assembly plant, but they're not completed. So they're called work in process. And then we have some products in finished goods that are already been completed, but they're in the warehouse waiting to be sold. These are costs that have yet to be incurred as an expense because the product has yet to be sold. And that's why. So here's a balance sheets for different types of companies. And I thought this was interesting. A service company, a merchandising company that produces and buys product for retail, and a manufacturing company that buys the materials and produces a product. Three different main types of businesses in our economy. Notice the service company. No inventory. You provide a service. We don't build a product. We don't purchase a product for resale. We're just providing a service. So a service company has no inventory. A merchandising company has merchandise inventory, retail. They buy a product from Nike. They buy about 10,000 shoes from Nike. They bring them to their warehouse. They put them in the warehouse, put them on their shelves, and until they're sold, they're called merchandise inventory. Once they're sold, they hit the income statement as cost of goods sold. And then in a manufacturing company, it gets a little bit more complicated because there you have three levels of inventory making up your assets. Materials, products currently being built, and products that have been already built but waiting to be sold. If any of you have been following the automobile industry lately, you've noticed or you've read about that right now the finished goods inventory for many automobile companies is basically zero. They have maybe 1 or 2 or 3 days of inventory on hand. Why? Supply chain problems. Chips are not, there's a huge bad supply of microchips. And if any of you bought a car these days, computers run automobiles. Unbelievable. And without those microchips, cars aren't getting built. So what's going on? Huge selling of used cars. Anybody try renting a car lately through a rent-a-car agency? You're paying through the shorts on that. Why? Because most of the rental car companies are selling their cars to people who need and want to buy them. There's not too many rental cars left. I traveled a couple months ago to the Midwest. What I paid for a rental car from a week where before it was maybe $200 a week, now it was $1,000 a week. Any of you guys planning on going to Hawaii in the next few months? There are no rental cars in Hawaii. So plan on renting a bicycle.
Got lucky.
That is true,
car
because I'm
last
going
year.
to Hawaii, same thing.
Yeah. So
Yeah.
that's supply chain problems. Well, some of you might see these in some of your financial data in relation to the pandemic if you're a manufacturing company. So these
So then why is Ford at its all-time high on its stock?
Service company. Notice the income statement, revenues minus expenses. That's it. Notice a merchandising company. Now under cost of goods sold, you're showing the expense of buying the goods that were sold at retail. The retail price is sales, $310,000. This company, it cost them $171,400 at cost of goods sold to build or to buy the retail product that they sold for $310,000. That's called the gross profit. And then they have their other expenses. And look at manufacturing company. Now you have cost of goods sold being the difference of finished goods or what we've completed at the beginning of the year, adding in what we produced during the year, subtracting out what we have yet to sell at the end of the year to get our cost of goods sold. A little bit more complicated. This is the income statement side of these three types of industries. All of us in our class, you're looking at companies in your financial analysis that's either a service, a merchandise, or a manufacturing company. That plays a little bit in what the financials look like. And that's important as far as analytical and interpretive, which you'll be doing. We're a service agency. We provide a service. A bank would be considered a service company. What's their service? You stash your cash with them and they do something with it and they lend it out. That's a bank. A financial services company. A merchandising company, you got it, Amazon. A merchandising company, McDonald's. A manufacturing company, Ford. Boeing, a manufacturing company. So each one of your companies fits into this area, and that plays. How are service companies doing in 2019 and 20? How are merchandising companies, retail? It just came out yesterday that retail was way up in the month of June. June had a great month. But how was retail in 2020? In 2019, I bet your retail was down because of the pandemic. Manufacturing materials go into production. Once they're produced, then they go to finished goods. Once they're sold, they become an expense on the income statement. There are people in companies that their sole job is to keep track of materials, purchasing agents, warehouse people. You have people in companies, their sole purpose is called manufacturing, distribution, production. And you have people within companies, their sole function is manage and distribute the finished product. These are whole vast departments within major corporations. All producing a schedule of cost of goods manufactured. What did it cost us to produce our product this year? Notice it's made up of materials, labor, and overhead. But also notice we include work in process. We started out the year with such and such in production. We added additional manufacturing costs during the year, and this is what we ended up still in production at the end of the year. That difference is our cost of goods manufactured. Many companies break this down on a per unit basis. It cost us $17.98 to produce this product per unit. We're selling it for $30 a unit. What's the difference? It's called gross profit or gross margin. But the difference has to include selling and period cost, right? Then you make your profit. That's why companies mark up products high above production costs because they have to cover selling and period costs as well. It's a key definition of managerial accounting. Here's a cost of goods statement. We have materials going into production. We have labor going into production. This is why you have time cards. What'd you do today? Oh, I worked 8 hours on this production line. Okay, that labor will be allocated to this production. The next day, oh, I only worked 4 hours on production and I worked 4 hours doing office cleanup. Oh, then those 4 hours will be in production. The other 4 hours will be in the period costs for office. That's why we have time cards to keep track of all that stuff. And then you have your overhead costs. Materials, labor, and overhead are total manufacturing costs, $175,500. We started out the year with $2,500 of product in production already. Add that to our cost of this current year, $178,000 total cost of goods in production. And at the end of the year, we took an inventory and we found that $7,500 is still in production. So that means we completed $170,500 of completed cost of goods manufactured. For some of you, this probably means, oh, that's cool, Mr. Hasse. But for other us in the manufacturing business, this is huge. What did it? Because most of these numbers, you have a budget for materials. You have a budget for labor. You ever get anybody here ever get yelled at for authorizing overtime? Hey, what the hell are you doing? You're telling everybody to take overtime today? You know that's adding to our cost of today, and that means we're not going to make as much money today. What the hell are you doing? Yeah, but the job's not going to get done. Well, manage these people better. Well, I can't tell you how that happens a lot in my career. I was, as a manager or an owner, I was always yelling at my staff. If you need overtime, you better get my approval because I ain't giving it. Work it out during the day or complete it the next day. But overtime at time and a half or double time, there goes my profits for the day. Managing that is huge. And then overhead. What the hell? We're spending all this money on property taxes? Hey, maybe we should have our plant someplace else where it's cheaper to do business. Oh, okay, let's build it in China. But well, I don't know how many of my workers are going to want to live in China. So then we have to hire the labor there. Oh, we can hire 12-year-olds to do our factory work. Oh, we don't have to pay them anything. Oh, yes, we are moving to China. You don't think companies think about this? Give me a break. Okay, but see how all this data can tell us a lot of things, and that's the good thing about that. And more definitions. Okay. Notice this is a nice thing because it's taking the cost of goods manufactured of $170,500, and notice it's now putting it into the cost of goods sold section on the income statement. And then those ending inventories are part of the balance sheet. This is how that flow works. I'm not going to ask you to do any of this stuff, but it's good for you as MBA students to kind of get a handle on this flow. It makes sense. Okay. So that's chapter 14. Let's take a look. Here's our review problem for tonight. I'm on page 567, and we're looking at, hang on, let me make sure I got this here. We're looking at problem 14.1a on page 567. We're doing problems 14.2 and 3 as a work this week, but we're going to look at 14.1 right now. This will set up. This is a manufacturing company. They make drums. Good Lord, how'd you like to work there? They make drums. It's a manufacturing company, and here's a listing of all some of their expenses. Our job in this problem is to determine, are these product or period costs? Remember, if they're product costs, they go into what is called cost of goods manufactured. If they're period costs, they go into selling or general and administrative expenses on the income statement. All right, so I'm going to go through these. I don't want to call you guys out on this, but this is a good practice. The solutions, again, are in your Blackboard. Notice plastic for casing. I assume that's for casing for a drum. That's a product cost. Wages of assembly workers, product costs. Property taxes on the factory, product cost. That's an indirect cost, right? It's a factory overhead. Office accounting salaries, period, cost. Drum stands, product cost. Has to do with the drum. Rent cost of office for the accountants. Let them work out in the street, the hell with them. But in other words, the rent for where the accountants work. Period cost. Why? It's office. That's a period cost. Office management salaries. Office is the key word there. Period cost. Annual fee for factory maintenance. The key word there is factory. Product cost. Sales commissions. You know, I'm going to tell a little story here. I don't want to offend anybody, but I was a finance dude my whole career. Finance people cringe when they have to pay sales commissions to sellers. Ugh, that's a cost that just makes your skin crawl. Yes, they're being rewarded for selling your product and they should be compensated. But that was one cost that really irked me, those commissions. Ugh. All right, sales commissions, that's a period cost. Factory machinery depreciation. Again, the key word there is factory product cost. Okay, pretty easy, pretty easy. Classify each, which we just did, product or period. Okay, so now I've classified them. Now, what does it cost us to produce one drum? That's part number 2. So I want to list all the manufacturing or product costs and divide that by 1,000 units. That's what they produced. And that gives me our cost per unit. So let's take a look at that. Okay, here's where I determined, we just did product or period. And notice I'm not taking any period costs. I'm taking all these product costs and I'm listing them. Manufacturing costs. I'm not worried about any inventories here or anything like that. So it cost us $180,000 to produce this product this year. We produced 1,000 units. So that means we sold them, or we cost to produce each unit $180. Okay, here's my question to you all. All right, it cost them $180 to produce one drum. They have 100% markup to their customers. 100%. What do they sell them for per unit?
$360.
$360, exactly right. So many times companies figure out the cost first, and then they go, okay, we want to mark this up 100% because we need to have this sold for $360. So then we're making $180 gross profit per unit. But also we can't forget about these period costs, and we got to pay for those. And also we want to make a profit. So that's why we're going to double it. With that, we're making a nice profit. But here's a key, and some of you might have experience with this. Wait a minute, Mr. Hasse. No way are any of my customers going to pay $360 for a drum. They can go to Costco and get it for $300. They can go to Walmart and get it for $280. Now I got a pickle going, right? This is where selling and marketing information has to play into some of this. We can't mark it up 100%. We can only mark it up 1.5 or 50% because our market will only pay that.
Quick question, Professor
Yes,
Hasse.
Stephen. Cost volume relationships. And just like the video just said, we're trying to identify which costs change per unit or are affected by our production of the product and which costs are fixed, that no matter how many units we produce, those costs stay the same. So we're identifying cost behavior, just like we did in chapter 14 with some of those exercises. What is our period? What is our product? What is so far? Now we're looking in chapter 18, what are fixed and what are variable. A fixed cost do not change as volume changes. You sell more, you sell less, those costs stay the same. Okay, most fixed costs are like depreciation, rent, maybe salaries of administrative people. Those are fixed costs. Variable costs change. You produce more, you're going to have higher costs. You produce less, you're going to have lower costs. But on a per unit basis, they're always the same. Like in this last example, 50 cents a unit or whatever. Variable costs change with volume, but on a per unit basis, they stay the same. Fixed costs stay the same, but on a per unit basis, they always change according to volume. That's an interesting part of all this. So again, here's some examples. Do not worry about mixed or stepwise costs. We're not going there. We're just citing what are variable and fixed costs. Notice all our manufacturing costs, the materials, labor, are variable. Packaging, shipping, indirect materials. We produce more, all those costs will go up. If we produce less, all those costs will go down. But fixed costs, rent, property taxes, insurance, office salaries, depreciation, they stay the same no matter how many we're producing. That's why companies really monitor their fixed costs because they can be a deal breaker to profitability. So as I said in the video, we want to concern ourselves with what is our contribution margin. It's the difference between our selling price per unit and our variable costs per unit. And by that, we can get what is called the contribution margin ratio. What percent is that margin of total sales? For example, here's a company that sells their product for $100 per unit. Their variable costs are $70 a unit. That means their contribution margin is $30. $30 is what percent of the selling price? 30%. Okay. Their contribution margin is 30. Contribution margin in dollars is 30. Their contribution margin in a percent or ratio is 30%. Naturally, the higher the percentage, the higher the dollar margin per unit, the better. Because then you're going to get to profitability quicker it'll eat up those fixed costs. But the lower the contribution margin, trouble. And that's why a lot of companies in their budget planning say, we can't go below 25% contribution margin ratio. If we do, we're in big trouble. So you got to build those margins high to cover if you have a lot of fixed cost. The break-even point, like this gentleman just told us, is at what point of sales our profits equal zero? At what point do what we sell matches our variable costs per unit and our fixed costs? That's the break-even point. For example, the University of Laverne, I shouldn't probably tell you this, but the hell with them. The University of Laverne says if we don't have 8 students in a class, we're losing money. 8 students. You ever been in a class that's all of a sudden you go to directed study or it's been canceled? Now at Laverne, they don't do this very often because here's why. We're not in a position to tell students we're going to cancel class. We need every student. At a community college or even a state school, if they don't have 8, 9, 7 students in a class, they'll just cancel it no matter what. It depends. Also, when I had my business, I knew that if I had billable sales of 500 hours a month, I was going to cover all my costs. So before I even got any financial statements for the month, the day after a close of a month, like let's say July 2nd, I asked my office manager, how many billable hours did we have in June? And she said 600 billable hours. I said, thank you very much. I know we made money because my break-even point was 500 billable hours. But in some months, she came in and says, she kind of slithers in and says, hi, Rick, we had 300 billable hours this month. Get the hell out of here. Because I know we lost money. That's why this helps management. You know immediately during the course of a period of time, if you're meeting certain sales figures, you know that you're making money or not. You don't have to wait a couple of weeks or a week after your close of the month to tell you made a profit. I already know when I make a profit based on my break-even analysis. This is where this is a very important management tool. Do you ever work in a restaurant? And sometimes the people who run a restaurant know, hey, if we sell 100 meals a night, we got our costs covered. We sell 100 meals a night, we got our costs covered. Or if you go into a store, a retail store, Dick's Sporting Goods. Dick's Sporting Goods knows that if they have a $10,000 day, they're going to make money in total sales. They know they're going to make money because they know their break even point is like $8,500 a day. So as a manager, you build your strategy around making money as fast as possible, but how does that affect quality or performance? Welcome to managerial accounting. So one of the first things you should do tomorrow when you go to work is go to somebody in your business office and say, hey, what's our break even point? And they'll go, damn, you have HASI in your MBA program. Because nobody else would ask me those dumpy questions because I'm not going to tell you. But what's our break even point? Every manager of a business, and it even can be in government, every manager knows when their costs are covered. That's why all of a sudden in Steven's business, he's a firefighter. That's why they know in fire season formulas, my fixed costs were $24,000 and I had a $30 contribution margin, like in this problem. I know if I sell 800 units, I got my costs covered. All right. What's that in dollars? Well, if I take $24,000, my fixed costs, and divide it by my contribution margin ratio, which is 30%, I know if I sell $80,000 of sales, I got my costs up. So either way, units, 800, $80,000 in sales. If I'm a restaurant, meals could be units, total daily sales could be your break-even point in dollars. Either, whatever business you're in, you don't think Ford Motor Company, you don't think Amazon knows at the end of every day they push a button and say, hey, what do we sell today? Oh, good, we made money. Jeff can go fly up to outer space tomorrow. We got that covered.
I'm sure that's the last thing they think.
Trust me, you think there's somebody there who does. This is and when we get to finance and we have to worry about investors and we have to worry about one of the first thing a stockholder is going to ask, hey dudes, what's our break even point? How soon do we make money? What? Well, I don't know if I like that. Maybe we should get somebody better managing this company. So these are things that are very important to know. So then there's a financial statement that can be internally done, and it's called the contribution margin income statement. And this is something you're going to be doing this week. There's the regular income statement, which you have to show everybody, but internally, you can show what your break-even point is in like a contribution margin statement. I'm selling 800 units, that's $80,000. I have fixed costs at $70 a unit, that's $56,000. My fixed costs are $24,000, bungo. I'm not making any money. Somebody says, boy, that's an exciting statement. We're not making any money. But the statement is telling us that if we sell 801 units, we're going to make 70 bucks. If we sell 802 units, we're going to make $140. Why? Because at 800 units, all that $24,000 of fixed costs are covered. That's why managers of a major American corporations always look to make sure they can manage those fixed costs, because their contribution margins, the relationship between selling price and variable costs, if that's large enough, they can eat up those fixed costs quickly and get to profitability sooner. Welcome to the world of financial management. Your managerial accountants provide this data, which is key. Now, also you have what is called the margin of safety. And this sounds kind of corny, but it's good for a company to know that. Let's say we expect this year to sell 100,000. Our marketing people say, okay, guys, we're going to sell $100,000 this year. That's what we think our sales force and our advertising group can do. All right, we know our break-even point is $80,000 in sales. What's our margin of safety? 20%. So we know if we if we set $100,000 as our target, we have a margin there of making money of 20. It's called 20%. Naturally, the lower that margin of safety is, we're running the risk of knowing we're kind of not going to do very well. Now, this isn't used that much in companies. Some it is. Some sales groups, some salespeople use this margin of safety. But it gives you an idea. We expect to sell 100,000. We know 80,000 is our break-even point. We got $20,000 to work with. If all of a sudden our sales, hang on, Alex. If all of a sudden our sales group tells us, "Hey, dudes, I don't think we're going to make 100,000." So the finance people, like Mr. Hassey, goes, "Okay, what's it going to be?" It's going to be 90,000. Oh, I can live with that. We're still making 10,000. We're 10,000 over our break-even point. Okay, that's fine. But if all of a sudden the sales group says, "Looks like we're only going to hit 70,000," people start jumping out of the windows, because I know I'm at the bottom of page 733. All right, here we go. We're back to the drum company again. Here they're telling us their sales price is being $500, and they sold and produced 1,000 drum sets. Based on this data of variable costs and fixed, prepare a contribution margin income statement and tell me what the contribution margin per unit and the ratio is. Stuff that we just looked at. Instead of doing a regular income statement, show me a statement that shows me my break-even point. Okay? And then for Sunday, you're going to be doing problem 18.3. Here's the contribution margin income statement. It tells us at a volume of 1,000 drums being sold at $500, there's our revenue. There we list our variable costs given to us in the problem, 140,000. So our contribution margin is $360,000, the difference between sales or revenue and variable costs. Then we list our fixed expenses, 225,000. Our net income is 135,000. So what's our contribution margin per unit? Well, $500 is our selling price, and if we take $140,000, our total fixed cost, and divide it by the 1,000 units we're producing, that's $140. So our contribution margin is $360. What's our contribution margin ratio? The percent of our contribution margin, 360, to the selling price. A whopping 72%. That's good. That's our ratio. So in part 3, we know that our 72 cents per unit, or 72%, is our contribution margin. It's not asked in this problem, but we could calculate what our break-even point is. I'm going to leave that for your discussions. But this company is making $130,000 at selling $500 at 1,000 units. Their contribution margin is 72%. So to calculate their break-even in sales, what would you do? You would take 72% of $500,000, and there's their break-even in sales. That's how you would do that. So if I take $500,000 times 0.72, I know my break-even in sales is 360,000. Okay. That's a contribution margin statement. You're going to be looking at that in your 18-day